and welcome to IFRS Talks, your source for all things IFRS. I'm your host, Pandya. On today's podcast, I'm very excited to be joined again by our very own Gary Berchowitz. We'll be discussing the very exciting November 2025 IFRS Interpretations Committee meeting. Welcome back to the podcast, Gary.
Thanks, Anu. Good to be back.
So how was your second IFRS Interpretations Committee meeting?
It was pretty good, action-packed. We probably got through a lot more than the first one, so it was probably less exciting from that perspective. But I think there were a lot of good tentative agenda decisions and a lot of good debate, which we'll hopefully summarize now.
Yeah, exactly. Like you said, the agenda was really packed this time. There were actually 5 brand new submissions, and I think the theme from the last committee meeting was continued here because 4 of those submissions are actually on the new presentation and disclosure standard, IFRS 18. So as a reminder for our listeners, IFRS 18 is effective from 1 January 2027. At the other end of the spectrum from IFRS 18, the 5th submission was a fresh IS1 question, which is a standard that we'll be saying goodbye to when IFRS 18 kicks in. And then there were also follow-ups on previous tentative agenda decisions where the committee has now received feedback since they last discussed these items. And then also the committee's feedback was requested on one ISV project, which is a Business Combinations Disclosure Goodwill and Impairment project, which is a popular topic that always sparks plenty of discussion. So let's start off with the IFRS 18 submissions. But before we do that, for any listeners that might be less familiar with the requirements of IFRS 18, I would recommend giving a listen to our September 2025 IFRS Talks podcast, where we did an intro into IFRS 18. Today, we are going to be getting into some more details of the standards, so a refresher of the basics might be helpful. So Gary, let's start off by discussing the submission on assessing a specified main business activity for purposes of the separate financial statements of a parent. From some conversations that I've had, I think many companies have been really eagerly awaiting this discussion. So could you please tell us what the submission was about?
Yeah, sure, Anu. And although it was obviously the committee always looks at very specific fact patterns, I think there were some really good principles that came out of this one. But let me just maybe summarize the question that came in first. So someone sent a question to the committee saying, if you have a parent and for the purposes of the parent's separate financial statements, all that will be in the parent is a number of unconsolidated subsidiaries, so investments in subs, and the income that this parent is receiving is just the dividends in its separates from those subsidiaries. And so the question that came into the committee was, does this entity and its separates have a main business activity of investing? Because as we know, or those of us who know from reading IFRS 18, if you have a main business activity of investing, that dividend income would have been shown in the operating category rather than the investing category. And obviously a lot of IFRS reporters do prepare separate accounts, and so this is quite a common issue. So the committee decided it would make sense to answer the question.
Thanks, Gary. Yeah, like you said, that does sound like a pretty common fact pattern. So I'm glad this came to the committee for discussion if the requirements are not clear. So where did the committee end up landing on this?
Yeah, so maybe before I go into the answer that the committee got to on the specific question, what might actually be more helpful for listeners is actually, in my mind, there were 4 main principles that I think came out of this discussion. That's pretty helpful because I think it'll be more broadly applied than just this fact pattern. And the first was that determining whether or not an entity has a specified main business activity is judgmental, and that can be even more judgmental when you have more than one main business activity. In this case, the separates for the parent, you're only assessing whether or not its one activity was a specified main business activity. But I think what was quite helpful is this is a judgmental area, and entities are in often cases going to have to apply judgment. So there's no one size fits all. The second important principle was that IFRS 18 has some examples in the section around specified main business activities. The important thing here is just because you don't meet one of those examples doesn't mean you don't have a specified main business activity. So I think the important thing there is that those examples are not an exhaustive list. And so just because you don't align to one of those examples doesn't mean you might not have a specified main business activity of investing or financing. Second important principle. The third one was building on from something else that's in IFRS 18, saying when you're assessing main business activities or specified main business activities, you can get different answers. Well, the standard says you can get different answers in a subsidiary compared to the group. And I think that was just reaffirmed with this to say you could also get a different answer in the separates compared to the consolidated accounts. And the fourth important point that I think came out of this was an acknowledgement by the committee that an entity needs to have some type of main business activity. So you can't assume that an entity just exists as a shell that does nothing. So those were, in my mind, the four important things that came out. And if you kind of put that all together and say, well, where would we have gotten to in this example then? When the committee considered all of that together, I think there was the tentative agenda decision going to be that for this entity that's a parent that has unconsolidated subsidiaries, the income it receives from those subsidiaries are part of its main business activity, and therefore the dividends would be shown in operating.
Perfect. Thanks, Gary. I think those are all really helpful observations. I think for me, the takeaway is IFRS 18's indicators are just examples of evidence and not the only examples, and that there are other examples that a company might consider. So if we could then move on to the next IFRS 18 submission, and this one relates to classifications of gains and losses on a derivative that's managing a foreign currency exposure. What was the submission about?
Oh, yeah, this could use up the entire podcast all on its own. But so I'll try and explain this one, but it's quite a complicated one. But this is another question that is probably common for a lot of entities, and especially entities that have central treasury functions. And the issue of principle was for entities that are economically hedging risks within their groups. We're not talking about designated hedges. You might be economically hedging risks in your group. And the question was focusing on the bit in IFRS 18 that says you can put economic hedge results in the same category as the related risk, except when doing so would result in the entity needing to effectively gross up gains and losses on a single derivative. In which case, then IFRS 18 says the derivative gains and losses need to go into the operating category. Now, as I say, that's quite complicated. Let me try to use as simple an example as I can think of to try and bring this to life. So assume you have a parent that's got two subsidiaries, sub A and sub B, and the parent manages the treasury function as well. So sub A has a loan to a third party in a foreign currency. So in other words, it has an asset. It's got an investing asset of foreign currency 100, and it's going to earn income on that. Subsidiary B has got a loan from a different third party, but it's in the same foreign currency, and that's 120. So now you've got an asset of 100 in that foreign currency sitting in sub A. You've got a liability of that same foreign currency of 120 sitting in sub B. Now, there might be internal derivative contracts that the treasury functions got there, but on consolidation, the important thing is that the entity's net exposure from an external consolidated perspective, in my example, is obviously the 20 of foreign currency liability that's still left over. And so the treasury function enters into a forward contract with a third party for a notional amount of that foreign currency of 20. So in other words, from a consolidated perspective, the group is now comfortable that they've economically hedged that exposure. And so the question that was asked is, when you apply the requirements of IFRS 18, what do you do on that external derivative of 20 in the consolidated accounts?
Thanks, Gary. I can see why the classification of this derivative might not be as straightforward as it might seem. So what did the committee then conclude on this question?
Yeah, so again, if I go back to, hopefully good principles that the committee clarified, what's key in this fact pattern is that the group's risk management policy, even though it's not a designated hedge, their internal risk management policy makes it clear that the purpose of that external derivative was to manage the foreign currency risk of that remaining net exposure of 20. And therefore, because what they were trying to hedge was just 20, there is no grossing up. And therefore, the grossing up prohibition wouldn't have been triggered because the group is just using the derivative to manage an identified risk which would affect only a single category in the income statement, that is financing. And so in the fact pattern that the committee was provided with, the group's internal risk management policy was just to hedge the 20 remaining amount, and that 20 sitting in financing, the gross up prohibition wasn't actually triggered. I think what is important to highlight is if the fact pattern had been different, and if the group had said, our internal risk management policy is that we have a gross position of 100 and a gross position of 120, and we hedge that using this remaining 20 derivative. And so what we want to do is we want to take that derivative, the external derivative of 20, and pretend that it's actually a derivative that's hedging 100 investment and 120 of liability, and effectively blow up that single gain or loss on the derivative into a gross investing piece and a gross financing piece, then the prohibition would have kicked in. So I think although, the question made it very simple to answer in my mind, but I think the important thing there is, in terms of a principle, today, how you think about your internal hedging if you're not applying hedge accounting isn't really that important. I think what this demonstrated is how you document things internally, even if you're not going to apply hedge accounting, may be important in the future under IFRS 18 so that you don't trip up the grossing up prohibition.
Perfect. That makes a lot of sense, Gary. Thank you for that. So I think that then covers the submission on derivatives. So if you can then move on to the next submission, which was about the scope of the requirement to disclose expenses by nature under IFRS 18. What was the submission about?
Yeah, thanks, Anu. And I think this one is probably coming from the insurance industry, and it'll be clear why I'm saying that now. Because as folks recall, IFRS 18 requires certain line items to be presented in the income statement. And for entities with insurance activity, this includes line items required by IFRS 17. So there's some very specific IFRS 17 and IFRS 9 items that are required to be presented. And so folks may also recall that if you present an income statement that includes any items by function, you then are tripped up and you have to disclose specific information on the nature of some line items like depreciation, amortization, and employee benefits. And the question here was whether this means an insurer needs to worry about the requirement to provide the nature information if they have been required to provide an income statement using the IFRS 17 items that are listed in IFRS 18. Sorry, a lot of references to standards. But I think there the committee noted that if there are any line items, even if they're required by IFRS 17, that are presenting a functional a line item, then the requirement to provide information about the nature of expenses still kicks in. So what this means is that, even if an insurer has provided all of the IFRS 17 required line items as a result of IFRS 18, if there's still some functional line items in there, the insurer would still need to provide that detailed note that gives information on depreciation, employee benefits, and the other required line items. So which might not be that easy to get from a system, but it is still going to be required under IFRS 18.
Okay, thanks, Gary. I think that's pretty clear then. So if we move on to the fourth and final IFRS 18 submission for this meeting, the next one was about presentation of taxes or other charges that are not income taxes. What did the committee discuss here?
Yeah, so the committee discussed here whether when you move to IFRS 18, an entity is permitted to present non-taxes, but things that feel like taxes. So in other words, things that aren't in the scope of IS 12, can they still be included in the taxes category of the income statement? And this matter was actually referred to the committee by the ISB, so it didn't come from someone externally, but the ISB thought it made sense that this was clarified. And I think here where the committee got to on this one was the tentative agenda decision saying you can only put IS 12 taxes and any related income expenses of those IS 12 taxes in the taxes category. So, what that means is today, because IS 1's maybe a little bit more flexible, some people might be putting other things in the tax line. I think when we move to IFRS 18, it's going to be, if this agenda decision gets finalized, pretty clear that the only thing that will be sitting in the tax category is taxes and the related income expenses as a result of IS 12. Now, I think maybe if I take a couple more seconds on this one because it's near and dear to my heart, but there were some members of the committee, did note that this isn't really an IFRS 18 question, but it's more of an IS 12 question. And the reason I say that is because sometimes this line that we have between is something in the scope of IS 12 or not in the scope of IS 12, in other words, an IS 12 tax versus a non-tax, for things that look and smell a lot like a tax can really get blurred. And some members of the committee, also noted that there's nothing stopping someone as a result, if they move to IFRS 18 and they're caught with this, calling out these non-tax expenses in the operating category if that would provide a useful structured summary. So not an ideal answer for folks who feel this is not going to provide the right answer, but at least there are still tools within IFRS 18 that allows folks to call these numbers out if they think that would be important.
Okay, understood. Okay, so potentially some changes for those under IS1 that might be showing those charges under the income tax line item today under IS1. Perfect. Thank you, Gary. So if we can then shift gears from IFRS 18 to a standard that's actually been out there for ages, I was quite surprised to see that the committee got a question about IS1. And this one was about fair presentation and compliance. So what was the submission looking for here exactly?
Yeah, so this submission describes a situation in which the entity, which is still applying IS1, departs from a requirement in an IFRS accounting standard. And this is commonly referred to as the true and fair override. I think, to be fair, probably not really much to say about this one because the committee unanimously agreed that, the matter described doesn't have widespread effect. And therefore, there was very little discussion. And I think the TAD will just say it doesn't have widespread effect. So the committee didn't consider it.
Okay, perfect. So that's an easy one then.
Yeah.
So what are the next steps for these 5 submissions that were presented to the committee?
Yeah, so that's a good point. So, and I think I might have mentioned for a couple of them, but probably good to bring it back to all of them. So it was agreed that no standard setting projects would be added as a result of any of these submissions. Instead, there'll be 5 tentative agenda decisions that'll go out, and as per the normal process, folks will have 60 days to comment on them, and they'll be available for comments as always on the IFRS Foundation's website. So if anything we spoke about tickled anyone's fancy, feel free to read the tentative agenda decisions and put a comment letter in if you agree or disagree.
Perfect. Thank you, Gary. So next on the agenda was follow-ups to previous matters that was discussed by the committee. In our June 2025 podcast, we actually chatted to Carsten about the committee's work in updating previous agenda decisions for IFRS 18. Now, based on all of the feedback that the committee received on this package of tentative agenda decisions that they put out for comment, what did the committee actually decide based on that feedback?
I think without going into all of the detail from the previous discussions, just to give folks the 30,000-foot view, because IFRS 18 is replacing IS1, there's a lot of existing agenda decisions that currently refer to IS1. And so this was the project around how do we keep or not keep those agenda decisions by updating the references to IFRS 18 now rather than IS1. And without going into all of them individually, I think I'll just focus on the highlights of the important things that the committee decided. In my mind, there were 2 key decisions that were made on the feedback received. One of them is that for folks who still remember this agenda decision that's out there, at the time it was quite an important one, but presentation of income and expenses arising on financial instruments with a negative yield. So this was quite an important agenda decision back in the day when, as a result of very, very low interest rates, some instruments were actually generating a negative interest. So instead of getting 2%, you were getting minus 1% for leaving your money in a bank. But I think because the committee was concerned that there were some issues related potentially to aggregation and disaggregation and offsetting, which IFRS 18 has made some limited changes to, at least on the aggregation side, it would make more sense to remove this agenda decision for now because it didn't deal with all of that. So that one is going to be removed. And the second important, probably more relevant or more pervasive, was, folks may recall, quite an in-depth agenda decision on reverse factoring or supplier financing. Now, the committee has actually proposed to remove that agenda decision as well for 2 key reasons. I think the one is, since that agenda decision was originally issued, there have been amendments to IS7 which require a whole lot of more disclosure now. And so part of that agenda decision was talking about disclosure, which has effectively been superseded by new requirements in IS7. And the second reason was because there's some things in that agenda decision which, again, are really touching on principles of aggregation and disaggregation, which IFRS 18 does have new requirements for, and the committee had a concern that it was imputing things that maybe we hadn't had a robust discussion on. And so I think on balance, the committee thought it was a better idea to remove that agenda decision as well when IFRS 18 becomes effective. And the last thing I'll say is the committee then agreed to finalize the updates to the other, I think it was 8 agenda decisions that do incorporate IFRS 18 rather than IS1.
Perfect. That's very clear. Thank you, Gary. I also saw that the committee discussed 2 IFRS 9 related agenda decisions. One was relating to embedded prepayment options, and the other one was on accounting for transaction costs. For any listeners that are looking for additional context about what these questions were about, please do go back and listen to our June 2025 podcast, where we got into some details of what these questions were relating to. But Gary, if I could ask you, what was decided finally then on these 2 items based on the feedback that the committee received?
Yes, the good news is that, based on the feedback, the committee agreed that those agenda decisions should be finalized. There might be a couple more minor wording changes. So if the ISB doesn't object, then those agenda decisions, as well as the majority of the IFRS 18 ones, will be issued as final.
Perfect. Now, Gary, the last item on the agenda was that the committee discussed the Business Combinations Disclosure Goodwill and Impairment Project, so BCDGI for short. Could you give us some high-level context about what the committee's discussions were about this project this time around?
Yeah, and it's funny. I know you said the long word and then you said BCDGI. I mean, I said that the other day to someone and they were like, say what again? So I think for those of us who've been following this project for a long time, the words just roll off the tongue. But yeah, the Business Combinations Disclosure Goodwill and Impairment Project, known as BCDGI for short. Yeah, so it keeps coming back because I think there's a couple of issues that, between the staff and the board, they really want to make sure they get right. And the majority of this discussion was actually on the scope of the business combinations that would be subject to the new disclosures around the targets or the synergies that a company thought that they were going to be able to monetize as a result of the business combination. So you'll remember that the exposure draft proposed entities provide acquisition date key objectives and related targets, and then they later provide a statement on whether or not the actual performance was meeting those objectives. And, although that's, I think, going to be really relevant information, there were a lot of concerns raised about the auditability of that, when the targets involve non-financial metrics, and as well as whether or not that is forward-looking information, or should that actually be sitting somewhere else in annual reports or in investor presentations. And so I think what the committee was asked here was, again, questions around tweaks that the staff was thinking of to try and alleviate those concerns. I don't want to go into a huge amount of detail, only to maybe say that if you want to go back and watch some of the discussion at the committee, there were a lot of diverse views. I think everything from investors saying very supportive, you should go with this, to some folks saying this is forward-looking information, the board should not be requiring any of it at all. So I think my takeaway here is I think the committee gave mixed messages to the staff in terms of how they might think about moving that forward. So I'm not sure there was necessarily a very clear direction provided by the committee, but hopefully still helpful comments as the staff move that one forward.
Perfect. Thank you so much, Gary. I think you've covered a lot of ground. You've summarized basically 2 days of debate in this discussion. So thank you so much for all of your insights. It's been really helpful. Do you have any last messages for our listeners?
Maybe 2 last messages. I think the first one would be just that the committee did observe that if you think of the effective date of IFRS 18, it's going to be effective in 2027. But if you add when there are committee meetings, once a quarter, and the fact that there's normally a 60-day comment period for any tentative agenda decision, if anyone has any burning IFRS 18 questions, once we go past the March committee meeting, there's only going to be final agenda decisions when we're already in 2027. If anyone has burning questions, I think March is going to be the last committee meeting where we'll get answers before IFRS 18 is effective. So if there's anything that we think we definitely need the committee to answer, get the pens going maybe over the festive season, which leads me into my last message, or my second message, which is just for those who are celebrating, have a lovely Christmas and a great New Year, and we'll see you all in 2026.
Thank you so much for all of your insights today. And I'd like to say a big thank you to our listeners for tuning in, not just to this episode, but for all of our 2025 episodes as well. To never miss an episode, please remember to subscribe wherever you get your podcasts. And until next time, happy accounting and reporting.
This podcast has been brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitution for consultation with professional advisors.